Hello, everyone. Today on the final bar, my guest is Jeff Huge from JWH Investments in Minneapolis. He's going to talk to us about the big picture update on his view from October, which is the last time he was here. Interesting to see we're in an interesting sort of transition phase. Which way is next for stocks, and one stock in particular to pay attention to. Overall distribution mode continues with the S&P selling off going into the close. The Nasdaq technology weighing the heaviest. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market activity using the power of charts, the power of technical analysis, the power of data visualization. As I've told many people, we can debate headwinds and tailwinds of the market, what should work, what could work. At the end of the day, charts tell you what are actually working, what is actually working, what's leading, what's lagging, what's working, what's not working, what's on the move. And again, the reasons as to why those patterns evolve usually make a lot of sense down the road a while. In the heat of the moment, I would argue you're best served by focusing on the supply and demand that is represented by the charts. This tells you where people are voting with their feet, with their capital. And that's the way to make sense of things. We're going to look at a lot of themes today. We're going to dig a little bit into breadth conditions, which are evolving actively as the market sells off overall. We're going to look at some of the differentiation here in our market recap, looking at stocks that are working, stocks and sectors that are not. Having said that, we have some great guests coming through the final bar. We had Jonathan Krinsky yesterday from Baycrest Partners, which was a lot of fun. Jeff Huge today from JWH Investments. And tomorrow, Ari Wald from Oppenheimer. Next week, on Tuesday, we have Jesse Felder from the Felder Report. And then on Wednesday, the 10th, Dana Lyons from the Lions Share Report. So some fantastic guests helping us make sense of everything. Also, mark it in your calendar, March 22nd, which is a Monday. We will do Chart Madness. This is our bracketology style stock picking exercise for experts. It's going to be a group of us. They're going to have a bracket of 16 stocks. We're going to debate the technical merits of each matchup and pick our final four. It'd be interesting if you would follow along with us and see how your picks match up with some of ours. Let's get to our market recap. We're going to focus on the distribution phase. And, again, arguing with some of my peers in a very friendly and collegial way today. Is this a distribution or is it a rotation? And I'm hearing mixed signals. Some people argue on a day like today when energy financials are up, when stocks like American Express are going higher, along with a lot of other things as well in both of those sectors, and technology, consumer communication services are going down. That is a clear rotation. Certain groups are working, certain aren't. The problem I have with that, and the reason why I'm not in that camp and more in I think this is more of a distribution phase, is the question is, can energy and financials doing well hold up the market when you think of the market, it's more of the stocks down here. When you think of the leadership, you think of the big mega cap stocks that are big benchmark names that a lot of people are expecting to go higher. It's the three sectors at the bottom of the list right now. And it's hard for me to believe that equities as a whole are doing well when stocks like Facebook and Amazon are breaking their 200-day moving averages. I just don't see it. I could totally be wrong. And don't get me wrong, stocks that are going up, the XLE is in an uptrend. Absolutely right. A lot of energy names, a lot of banks are in uptrends. I would argue you should continue to follow trends until proven otherwise. That is always the stock picker's exercise, the trend followers methodology. However, when I'm thinking of the market as a whole, I don't see the Nasdaq selling off to the degree it is. If that continues and having quote unquote the market, the equity markets as a whole feeling like a good place to allocate. And what happens is that can be a feedback loop. When people start losing on those larger benchmark types of names and they feel the need to take some of the risk off, that takes the risk off of other places where they may normally be chasing things like banks and American Express and energy stocks and others that have been in good phases. So the question is there enough buying power left around to keep up an equity market that is seeing distribution in some of the bellwether stocks in the FANMAG or FANG groups? It remains to be seen. Let's look at the markets themselves today. The S&P down 1.3%. The Nasdaq down even more, with the Nasdaq 100 down almost 3% today. Mid caps down a little less. Small caps actually up a little bit. Now, this is where the sector distributions make sense. When you're looking at mid caps and small caps, you're a lot more weighted in things like energy and financials than you are in large caps, where you have less cap represented there in those sectors. So makes sense on a day when you see leadership there that small caps would do just fine relative to others. Other asset classes very quickly, 10-year yields reapproaching the 1.5% level with the TLT down about 1% today. Commodities mixed. The DBC was up okay because oil prices were higher, energy stocks higher. Gold, precious metals were actually down today. Finally, cryptocurrencies pretty much across the board were positive, with Bitcoin closing just below 51,000, up about 4% from yesterday. So plenty of volatility as always in those spaces. When we look at a chart of the S&P 500, just to start, it concerns me overall what we talk about, this bearish divergence where the price is going higher. The momentum, the RSI is sloping downwards, and that pattern of higher highs in price, lower peaks in RSI is something we've seen mirrored in places like some energy for sure, but especially something like semiconductors. That's the example that I've shared with a lot of people, sort of indicating that lessening of momentum as the price goes higher. That's certainly a bit of a concern, but for me, that is what puts it on the list. That doesn't tell you that something bad is happening. That tells you there is a strong potential of something starting to change, a potential change of character on the chart. But that is one piece of the puzzle, as we've talked about. Looking at the daily chart of the S&P is, a bearish divergence would be sort of traditionally step one of a negative pattern. Breaking down through trendline support would be step two. We've done that now in a couple ways, right? A couple different trend lines we've now broken. It's the 50-day moving average. We closed right there on Friday's session. We have now closed there, right there again, almost to the penny today on Wednesday's session. The question is that going to be able to hold or not? If it doesn't, I think the next line, the ultimate line in the sand in terms of, agreeing whether the S&P is an uptrend or not, is whether we break 3,700. That would be the swing low from the end of January. If that holds overall, you could still argue we're making a pattern of higher highs and higher lows. Things are okay. If you break down through S&P 3,700, I would be thinking about the much higher potential, higher risk of stocks going materially lower than where they're at. And while that's not a definite, and I'm not saying it's absolutely going to happen, it's just there's a higher probability, a non-zero probability, and a growing probability that we could test further support levels down to 3,500, the 200-day moving average, down to 3,200, which would be the low from last September and October. Right? There's a risk that we get down to those levels, if not even more. So as investors think about that increased potential and think about how they manage risk between where we're at and where we could go, that's when you start to see further de-risking. That's when you start to see a sell-off ensue as people continue to take bets off of the table. But first things first, we have to break these levels. We have not broken the 50-day moving average yet. It's on tap. Maybe for tomorrow or Friday, we'll have to see. And then 3,700 will be the next level to look at. As I mentioned, in terms of sector rotation, this is very much a continued pattern of rotating away from sort of the new economy sectors of technology, consumer discretionary, communication services, into the old economy, energy, financials. Let's look at a couple of those charts just to think about some of the patterns and what they might mean. Again, stock like Facebook going below its 200-day moving average. If you don't own Facebook, is that a huge problem? Maybe not, because you don't have direct exposure to it. But if you own any sort of index fund or any sort of passive fund with an allocation to the largest stocks, with any big fund would have to be allocated to a stock like this just because of the size of it. There's certainly a challenge when it gets below its 200-day moving average. And if there's a flight away from these stocks, the question is, where do assets go? Do they go into other names in the equity landscape, or do they go outside of equities and they go somewhere else chasing yield or doing something like that? They go into bonds, given the fact that rates are actually decent enough that you actually get a fair payment for owning a treasury bond, a corporate bond. Potentially, right? And so those are the things to think about. I think the challenge with something like Facebook looking like this, now closing back below its 200-day moving average, Amazon closing below its 200-day moving average, now testing 3,000, which is a big round number, which often serves as a key point to watch. That's my concern. Stocks like this are breaking down. The more of these happen, the more it's a feedback loop, and the more we'll start to see them as people take risk off the table. Amazon's a really interesting chart. Not only is it below its 200-day moving average for the first time since last March, a year ago, it's also testing 3,000, a big round number. We mentioned that just now. The third thing is the RSI. If you look at the bottom and you look at the relative strength index, the RSI really hasn't been above 60 since last September. So since the September peak, where the S&P was range bound for a while and then rallied and continued on to new highs in November, December, January, February, Amazon just has not participated at all since the September peak. It's been sideways that entire period, and now it's at the lower end of that range. So the RSI has been more in a bearish phase than a bullish phase. It's been more, when the RSI doesn't get above 60 when a stock rallies, that tells you it's more distributive overall, right? It's more in a distribution phase, more in a bearish phase than a bullish phase. That's cause for concern. Semiconductors, we've talked about that before. We might have to leave it here, but again, I'm certain this chart will be featured in future tests and textbooks on technical analysis, because you have a clear bearish divergence. Either this is completely validated by the SMH getting below its 50-day, which it has done today. Does it get below 225, which would be the January low, which would validate that bearish divergence and signal a full distribution? Or does this fail? Do we bounce off the 50-day, return to new highs, and indicate that semiconductors, this bearish divergence is not materializing? Things are not bad as they may seem today. I am prepared mentally for that latter choice, that the stocks like semiconductors recover from here. I am planning much more for the former, thinking of this as a bearish divergence that has not just yet been validated, but when it does, I think there could be a flight to the exits, and that's what I think we should all be thinking of risk-wise in terms of the potential risk of further downside. Folks, we need to take a quick commercial break. Back with my guest, Jeff Hughes. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So good to have you join us every weekday after the close as we break down the technical themes of the day. As a reminder, we'll do another mailbag segment on Friday's show. We would love to hear from you and answer one of your questions on the air. Shoot us an email, thefinalbar@stockcharts.com. Tag us on Twitter @FinalBarSCTV. On our YouTube channel, just put a comment below the video that you're watching. We'd love to answer one of your questions in our next mailbag segment on Friday. Also, just to remind you, the new StockCharts TV on demand is out and ready for you to consume all of our great content, fantastic hosts providing their latest ideas and approaches. Go to stockchartstv.com to set up a free account, or go to any of the app stores, Apple, Android, Amazon Fire, whatever it is, Roku, we're on all of those. Download the app for free, set up an account. You can watch all of the content anywhere you like. I want to welcome on our guest, Jeff Hughes. Jeff is from JWH Investments in Minneapolis. I've followed Jeff's work for a number of years and very much value his approach. Jeff, last time you were on the show was October, sort of a similar consolidation phase, right?
Exactly, Dave. Thanks for having me on the show. Back on October 19th, when we last spoke, we were in this kind of bifurcated market where I think we kind of are again today. And, at the time, we were looking for a resolution above or below resistance or support. Our resistance at the time was around 3,600, support around 3,200. And as we all know, vaccine news from Pfizer on November 9th kind of changed the game. We resolved above that resistance level, and the market has been trending steadily higher up until about late January, where again, we've gotten a little bit of a dust up, much like the dust up we've seen in the Nasdaq last week and this week, which has kind of raised some concerns. There have been a variety of influential factors in the market that are driving this. Rising interest rates, for example, right now seems to be putting pressure on tech. At least that's the consensus narrative. The thinking from my perspective is that, perhaps we could see some additional pressure on the Nasdaq. And given the heavy weighting of the big five, the FANG names in the S&P, we could indeed see additional pressure. But I think where we stand right now is we're kind of comfortably in the channel that's been advancing since, basically last May. And it appears to me that the market wants to kind of consolidate laterally rather than down. Last time we saw this sort of price action at I think a larger degree of trend, which was kind of back in the fall. We had a lateral sort of consolidation, and it looks like we're at a smaller degree of trend now, and the same sort of function could be underway. I'm optimistic that we're going to hold the 50-day moving average. That's initial support right now. I think if in fact we do break it, then 3,700 is almost a foregone conclusion. That's where all the buying pressure should come in and support the market. If it doesn't, then the market would have risk to around 3,400, which was the February 2020 high prior to the sell-off in March. Now, if the market does consolidate laterally, then I think we can have additional pressure on the 3,950 level. Our target back in October was 4,000. We're just about there. We see a setup that could potentially take the market as high as 4,600. We get there using a variety of measured move calculations. They're all kind of congealing around that 4,600 level. So our bull target is for 4,600 on the S&P 500 this year. However, if we do get a breakdown below 3,700, then I think we could see the market come under pressure and take us down into the 3,400 range. Having said,
that's
go
such
ahead.
a great take, Jeff. I was going to say, and I love your point where you mentioned that, you call it the lateral move. I think a lot of people, when they hear correction, they think a price correction and a pullback of X%, but right, markets can correct in time and or price or a combination of the two, right?
Exactly. Our bottom-up work is actually quite constructive. We've seen a lot of new 52-week highs in financials and energy, as you've kind of alluded to in your comments earlier. But one area that's getting less attention that I think is really important is consumer discretionary. If one were to look at the sector itself, they would immediately come to the conclusion that it's underperforming. It's down for the year. It was down in the month of February. But that's the cap-weighted index, which is heavily influenced by Amazon, which, to your point earlier, is now trading under its 200-day moving average and really hasn't done much since last September. It's also heavily influenced by the introduction of Tesla. And Tesla has been underperforming substantially over the last month and a half. And so with that heavyweight influence, it really makes the consumer discretionary space in general look weak. However, if you look at it on an equal weight basis, we were up about almost 10%, 9.7% in the month of February. And a lot of the names that are bubbling up are, names that you wouldn't pay a lot of attention to. Tractor Supply Company, Hanes Brands, making huge breakouts last month and just consolidating nicely. The other day, we were doing our normal 52-week high screens, and an interesting name popped up, and that's Starbucks, which is on the screen right now, as you can see. We made a new all-time high on Friday, February 26th, and that was followed through on Monday, March 1st, with another new all-time high. However, we did close back below the breakout level. Now, it's often the case that once you break out of a pattern of this nature, let's call it an inverted head and shoulders. You can call it whatever nickname you want, but clearly it's a lateral consolidation pattern that's broken out to new highs. And oftentimes you get a check back, sometimes to the 20-day, sometimes to the 10-day moving average. But usually those moving averages tend to hold and you get the next follow-through move. We are looking at, on the bottom panel of this chart, relative strength and the momentum of relative strength. The red line being relative strength versus the S&P 500, the green line being its second derivative, the momentum of relative strength itself. And both are turning up in tandem, which is a good sign. That's indicative of money coming in. The other thing that I'm not showing in this chart is volume. And importantly, on Friday, when we saw the breakout to a new high, there was evidence of I like to follow in the footsteps of giants, okay? Meaning that there's institutional buying. It's evident in the volume numbers, which were huge on Friday last week. And the stock has consolidated back on far less volume, light volume today and yesterday in particular, which gives me confidence that we can take this to the next level. And actually, if you pan out and take a look at this on a weekly basis over the last 3 years, you can see a much bigger pattern evolving. We've actually been in and out of this stock for a while, and it did break out and fail at the 100 level. It pulled back through its 10-week moving average, kind of the 50-day moving average, if you will. But this latest breakout gives us confidence that the next leg of this move could be something fairly significant. We're targeting initially about $118 for the move out of the current daily pattern, but the bigger picture pattern actually gives us a count to as high as $150. Now, it's not going to go directly there. We don't expect a parabolic move to 150, but we think we can get there in steps, stair steps to the 120, then 140, then possibly 150 and higher. If we look at the bottom panel here, we can see that relative strength continues to be positive. The momentum of relative strength has turned negative on a 30-week basis. However, it's flattening out. And based on the action that we're seeing in the daily chart, we have a hunch that we're going to see that momentum turn up, and relative strength should reassert itself on the weekly chart. Bear in mind that all of these calculations, all these indicators are a function of price. So they lag price action itself. And that's where we're really focused right now, is the price action.
Jeff, we'll have to leave it there. This is such a great opportunity to sort of get inside your head a bit, think about the big picture, but then a particular stock with an interesting setup and potential upside. Listen, thanks so much for coming on. Hope those around you stay safe, and we'll talk to you again soon.
My pleasure, Dave. Best to you.
That was Jeff Hughes from JWH Investments. We're a little long on time, but boy, I love to just hear him walk through that entire sort of investment thesis, thinking of the big picture and understanding this potential for a corrective pattern, but also, individual names. And I think he hit on a point I was trying to describe earlier. I think he did a really good job of explaining, which was, the market's doing one thing, but when I'm screaming for new 52-week highs, I'm seeing a lot of names come up, and here's one of them that came up. So I love that balance of the big picture, the top-down approach versus the bottom-up, and always looking for opportunities. This is a fantastic run through and a stock Starbucks with a potential for further upside. We need to continue on our next segment. We're going to do banking on breadth, a quick check-in on some of the breadth indicators and what they've been doing. This is sort of an interesting mixed bag of signals. I've sort of described the breadth as mixed. My guest yesterday, Jonathan Krinsky, was probably a little more optimistic. If you heard how we describe breadth, he describes breadth as being very supportive, as showing a strong trend in good shape. And I totally see what he's talking about. I'm looking at some of those same charts, but drawing a different conclusion in a way, just seeing that there are mixed examples. I think with certain indicators, you're certainly seeing that strength, and this is one of them. If you look at the cumulative advanced decline lines, even with the pullback that we've seen this week, these cumulative advanced decline lines still continuing to make higher highs and higher lows. The trend overall on stocks remains higher highs, higher lows. As long as we remain above 37.10 or so on a closing basis, that's still in place. And the cumulative advanced decline lines going higher as well. Until that pattern's changing, it's hard to get too negative about stocks overall, because all this tells you is every time we go higher, stocks are participating in that. There's better buying that's driving, the average stock higher. If you look at other indications, though, it's a little less rosy, and this would be the chart I keep coming back to, which is two that I'll show you. One is the percent of stocks above their moving averages. The other one's the bullish percent characteristic. So this is looking at the percent of stocks above their 50-day moving average. You can see starting really in December, that was the first time we made a new high in price, and we did not make a new high in the percent of stocks above their 50-day. Since then, it's really sloped downwards in this divergence of higher highs here, but then lower peaks in the percent above their 50-day. What that tells you is stocks like the S&P testing its 50-day, stocks are breaking below their own 50-day moving averages. And then when the market bounces higher, they're not getting back above the 50-day. That is a pattern of distribution as more and more stocks are unable to get back into, that bullish signal of getting above the 50-day moving average. What's a little more concerning now is you're seeing a bit of a divergence here at the percent of stocks above their 200-day. You can see that's been sloping downwards over the last 6 weeks or so, not as exaggerated as the stocks above their 50-day, because the 200-day is a lot further down. Obviously, you see stocks like Amazon and Facebook, which have been below their 50-day, just closing below their 200-day today. So it's still early on for a lot of stocks doing it. It's still above 80% that are above their 200-day moving average. So 4 out of 5 S&P names still in a bullish phase according to their 200-day, but you're seeing more and more stocks break down through it. And that's where I think is a bit of a concern there. The second one is looking at the bullish percent index that is here. So the bullish percent index basically looks at 500 point and figure charts. All the S&P 500 members was the most recent signal a buy signal, a break to new highs, or a sell signal, a break to new swing lows. And what this is telling you is we get below 70%. And as we have a bearish divergence, is less and less stocks getting back to a bullish pattern, meaning they're not breaking above swing highs. They're more distributing, right? They're more making lower lows and lower highs in the short term, right? They're unable to eclipse their previous highs. So you can see a clear divergence between that and the S&P itself. An interesting chart, maybe along breadth lines as well, is looking at this. This is the new high reading for the S&P 500. And again, I just did that question yesterday talking about new highs, and I promised I would always specify what I was looking at. Then I just didn't do it a moment ago. So sorry for that. The 52-week new highs, this is what we're looking at here in the S&P 500. What's happened in the last week, as you can see, that this is certainly dried up of sorts, right? You had 20% of the S&P make a new 52-week high about a week ago, and from there it's totally rolled over. So this line going down, and as the S&P going lower, less and less stocks making new 52-week highs. That is more characteristic of a bear market phase, of an unhealthy trend when you don't have a lot of stocks making new 52-week highs. The price going higher, with this being a robust number of stocks making new 52-week highs, is the sign of a healthy bull market. So what this tells me is we're looking more like an unhealthy bull market in the short term as opposed to a healthy one. Having said that, it's just what Jeff had pointed out and what I pointed out before. There are a series of lines in the sand you need to cross first to get really skeptical of further upside, or really think about the potential for further downside. For me, it's the 50-day. We haven't broken it yet. We just closed there today. It's 3,700 on the S&P. Do we get below that? If and when we do, as I promised, you will hear me talking a lot more about downside risk potential and risk off versus risk on. Until then, we're still holding up okay as a whole. We need to wrap the show. 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the bullish percent index. We just talked about some of the breadth conditions and how they've evolved. And this is one that I interviewed Helene Meisler not too long ago for Behind the Charts Season 2, which just started back up on Monday. We talked with Peter Brandt. We have a couple really good interviews lined up already that were just a lot of fun. I'm excited for you to see those. But when I was talking with Helene, it reminded me, she was one that we went back and forth a bit on this particular breadth indicator, just talking about a clear divergence of higher highs in price, lower peaks in the bullish percent. And again, what that means is when you look at a bunch of point and figure charts, less and less are switching back to bullish mode. And again, that doesn't mean the market's going to go to zero. It just means that the offense that we've seen, the acceleration that we've seen to the upside, is certainly lightening up. And a short-term correction looks like that. A long-term, deep, painful correction also looks like that well, and that's as well. So that's why you have to start mentally preparing for that as a potential outcome. Chart number 2 is the XLF. We're going to look at 2 sectors and how they differ right here. Earlier I was looking at the chart of Apple, then I quickly looked at the chart of American Express, AXP, just alphabetically looking at the Dow, and just the differences between those two were glaring. When you look at the financial sector, the XLF made a new 52-week high today, right? Made a new intraday high, touched 34, now closed a little bit lower around 33.50, but overall continuing to go higher and make higher highs and higher lows. What's most impressive on the financials is the relative strength. Start the clock at the November 1st of last year, and the relative strength has been fantastic. So financials, energy, both looking impressive. And when you zoom out on a chart like Starbucks, I think of some of the financial charts. When you zoom out on Deutsche Bank, which I talked yesterday with Jonathan Krinsky on, it feels like they've gone up a lot, but if you zoom out enough, they're really early on in terms of what the upside could be when you look at the bases that these are potentially breaking out of. So that's worth thinking of. Now, where are you seeing the rotation out? The Nasdaq, right? The technology sector, the communication services, consumer discretionary, which this index is going to be reflecting of. Now clearly below its 50-day, breaking below its low from January. This is one of the first major indexes to do so. The relative strength rolling over. This is the Qs, this is Nasdaq 100. That concerns me a great deal. Ladies and gentlemen, that is our show for today. Special thanks to Jeff Huge joining us from Minneapolis. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.